All right, so now we're talking about problem 2 with respect to substantial economic effect allocations. And it's important that you go through problem 1 because problem 1 sets the baseline for problem 2. So problem 1, again, focused on section 704B, substantial economic effect. So we got blueberry and mango. They organize the fruit smoothie partnership. Each contributes $50 for his partnership interest. The partnership purchases an apartment building for $1,000, making a $100 down payment with the money contributed by the partners and paying the remaining with a $900 mortgage loan that it took out from Big Apple Bank. The principal of the mortgage loan is payable in a single payment after 12 years. The partnership agreement provides the following. All income and deductions are allocated equally to the partners, except depreciation, which is allocated fully to Mango. So we have a special allocation. Anytime you see that, where you have depreciation allocated solely to one, it's a special allocation. Got to think about allocation issues. All income, gains, losses, and deductions will be reflected in the partner's capital accounts, maintained in accordance with the regs. Each partner will be entitled to liquidation, distribution amounts his or her positive capital account balances. The income of the partnership for each of the first few years are as follows. So we've got rent income, operating expenses, interest expense, depreciation. So what you see, look at this. They break even here, so all we have left is the depreciation. To make this problem a lot easier, we can just assume that they're going to break even in these first few years, except for depreciation. It's the easiest way to think about it. So basically just say, oh, it's zero, except for depreciation, which means that guess what? All of it's going to be allocated to Mango, exactly. So except depreciation. That's the easiest way to break this apart. Makes it a lot easier. Assuming the partnership operates for 2 years and then it sells the building at the beginning of year 3 for alternatively $1,100 or $800. How will the partnership's income, gain, loss, and deduction, including depreciation deductions, be allocated between Blueberry and Mango, and will the allocations be respected for federal income tax purposes in the following alternative variations? The first thing we're going to assume is, in these different variations, the partnership is a general partnership. The mortgage lender has full recourse, so it's a recourse liability. If we had non-recourse, it'd make issues. We're going to see that later on in later problems. With respect to the partnership and partners, and any partner having a deficit when either the partnership or his interest is liquidated must then make an additional capital contribution equals the deficit. So we're a general partnership here. Remember that under Reg 1.704-1B2, little 2i's, B, we've got the basic test. So again, this problem, it's a continuation of problem 1. So problem 1 starts you off with how to think about all this. We're continuing on. So you have to use the beginning part of problem 1 and then go into problem 2 here as well. So you combine both of these. So we're worried about, substantial economic effect. Then we go into economic effect. Economic effect, basic test first. Remember basic test? We look at, do we maintain positive capital account balances? Yes, we do. We're told that we, maintain capital accounts. That's what I meant to say, sorry. Yes, we do. We maintain capital accounts under the regs. Reg 1.704-1B2, little iv. The second is we liquidate the liquidation requirement in accordance with positive capital account balances. Say liquidation and positive. We're told in the problem they do that. And number 3, they've got an unlimited deficit restoration. So all 3 of these things we're told. Let's call it unlimited deficit obligation. So we're told in the problem that each partner will be entitled on liquidation to positive capital account. So that's number 2. We got maintaining, number right there. And then also we're told in this part of the question, you can call this question A if you want, that they must make additional capital contributions equal to the deficit. So unlimited. So we meet all 3 of these elements. So that means that under Reg 1.704-1B2 little 2i's B, we do meet economic effect. Okay? We do meet economic effect. We're not going to focus on substantiality in this problem. We're going to assume that the taxpayers meet substantiality. We're going to assume there's no NOLs by either partner, and they have the same tax rates. Tax rates are equal, and they're not going to change. They keep the same over several years. So substantiality basically becomes no issue. Okay. So with that, the next thing to do, so you're saying, okay, well then what do we have to do? The allocations are respected, right? They're respected, but we still need to focus on how exactly the allocations will take place. So even if a question asks you, oh yeah, will these be respected? You still need to go through the capital account balances, okay? So we've got two variations. In A, variation 1, we're going to sell the property for $1,100. In variation 2, we sell it for $800. Okay, so if we think about years, we're looking at end of year 2 and then the sale in year 3. So our initial balance, right, we've got Blueberry, I'm just going to say B and M. The initial balance is $50, right? They each contribute $50 and $50. So year 1 depreciation, remember it's a special, everything break even except depreciation. And Mango gets that. So nothing to Blueberry, minus 50 to Mango. The ending balance, let's say year 1, 50 and 0. Then we've got year 2 depreciation. Again, nothing to Blueberry. Mango minus 50. That brings us with a 50 balance and negative 50. So that's at the end of year 2. At that point, the book value at the end of year 2 is equal to what? Well, it started with, they spent how much on it? $1,000, right? So if you think about balance sheet, right? The book amount. They got $1,000, right? They used a $900 liability, $100 down payment. They've taken 2 years of depreciation, 100, right? So the book value is 900. If you sell for 1,100 minus the book value of 900, they've got a $200 gain. How are gains allocated? According to the partnership agreement, equally to the partners except depreciation. So we're going to split that 100, 100, right? 50-50. So the gain at the end, this is year 3, right? The beginning of year 3, no appreciation taken. 100, 100. So you'd have 150 and 50. G receives 150 if they liquidate, and L receives $50. Because the idea is that if the business liquidates after they sell the building, there's nothing left, guess what? They're going to have $1,100 in cash. They've got to pay the bank $900, right? And then they got $200 left. So how is that $200 going to be allocated? 150 to B, 50 to M. Because tax matches book, the allocation is going to be respected each year, the special allocation. If we do the same thing, assuming we sell for $800, so we do the same allocation, we get down to year 2. We have a 50 for B and 50 for M, negative 50 for M. Now if we sell for $800, we have what? $100 loss, right? Because the book value is, we're getting 800. The book value is still 900. We have a $100 loss. How do we allocate gains and losses? Again, 50-50. The only thing that has a special allocation is depreciation. Everything else, 50-50. So $50 of the loss and $50 of the loss. So the gain, loss in year 3, my apologies, is allocated 50-50. So the idea here now is they get $800 cash. The business is now gone. They have to pay the bank $900. They have $800. M pays the bank $100. Unlimited deficit. And therefore, it works. Tax matches book. Because with all the conditions that you have, it allows it to work. So when you're doing this type of problem on the exam, or any exam, you have to show that. You have to show how it worked out going through the years. That's why you show the capital accounts. And you write out, oh yeah, when they're liquidating, they have to pay the bank $900 because they still owe $900. So where does the other $100 come from if they get $800? Well, according to capital accounts, $100 comes from M. M has to pay the bank $100. So now, if the partnership is a limited partnership with Blueberry as general partner and Mango is limited, and remember, Mango gets the special allocation, the mortgage loan is still recourse. The partnership agreement says nothing about capital account deficit restoration on liquidation. If there is a QIO and Mango can go negative 50, will it be respected? Will the allocation be respected? So again, there is a QIO in place and Mango can go negative 50. So Mango says, I will go up to negative 50. So let's go through the same thing. Well, we meet the first requirement in the basic test. We meet the second requirement, but we fail the third. Why? Because Mango, the partner at issue, because Mango gets the special allocation, doesn't have to go unlimited. Does everyone see that? There's no unlimited. So that brings in the alternate test. The alternate test found also in Reg 1.704-1B. And the alternate test says you have to meet the first two criteria of the basic test. You have to have a QIO in place. And the fourth requirement is that you can only go either 0 or up to your negative amount you're willing to give up, right? Which is the $50 here. You can't go unlimited is the point, unless you're a general partner. But here it's a limited partner, right? Mango. So it looks like it'll be respected, at least part of the year, because we meet all these criteria, right? We read number 1, number 2, still is the case. We have a qualified income offset, and then Mango can go up to negative 50. So let's go through these variations for the years and see what happens. Well, Mango can go negative 50, so year 1 will be respected. Year 2 will be respected for both. If we sell it in year 3, we would allocate the same, wouldn't we? We'd allocate the same if it's a gain. So if it's an $1,100 sale, guess what? Under the alternate test, it would be the same exact result. Now, if we went into year 3 and depreciated and then we sold after year 4, that's where it would change. Now, you're going to see something change in a second. If we sell it for $800, at the end of year 2, it's still the same 50, and again, M can go negative 50. But guess what? With respect to losses, this can't happen. We can't have a negative 100 here. Right? This is what we had in the first part, problem A. Now we're in problem B. Now we're doing the alternate test. Whenever you see that, right, this is basically saying, hey, M, based on these capital accounts, is going to have to pay the bank $100. But the partnership agreement says that M only needs to go negative 50. Do you think M is really going to pay $50 beyond what M is required to pay? No. Economically, M is not required to. So who bears that $50? The general partner. The partner that has the unlimited liability. So what does that mean? So here's the issue. We can either reallocate the loss or the depreciation. Which one do you think makes more sense? The loss, right? Wouldn't the loss make more sense to reallocate? So this $50 of loss would be reallocated here to B, and then what you have, the result, B has a $50 loss and M has a $50 loss as well. So it's saying, okay, well, they get $800, they pay the bank 50 of it comes from M and 50 of it comes from B. And guess what? Does that make sense economically? Yes, based on what the partnership agreement says. Now, if you go into the next year and depreciate again, you'd reconstrue it. You give all the depreciation to the other party. Because once you hit that negative 50, once M hits 50, right? If we were to continue, let's assume we just went to the next year. Let's assume we didn't sell it and we just kept depreciating. So the end of year 2, right, we'd have 50 and negative 50. Now what happens? Year 3 depreciation. And again, we're assuming that the other things are going to break even, 0. Well, M can't go beyond negative 50. So that means that the basic test now fails. So basic test was met in year 1 and year 2, but now because M goes negative beyond negative 50, any dollar beyond negative 50, that test fails. So now we would apply Reg 1.704-1B3, the PIP rules. So it would go to PIP. It fails the basic test, yeah, because M is only willing to go negative 50. M won't go beyond that. Because economically, you think about, okay, what would happen if the business was to liquidate? Okay, well, if we put negative 60 on M, but M is really only going to do 50, that means the other partner is the one that bears the risk. So then what it does is it shifts over to PIP, Reg 1.704-1B3, which remember is a factors test. There is one exception to the PIP that you need to know, and that is for PIP, if we meet requirement 1 and 2 of the basic test, then we can do the hypothetical book value liquidation test. Basically what it says is if you go through and you were to liquidate at the end of year 3 and you assume book value, who would bear the risk of that depreciation? And of course it'd be G, right? Or a B, right? Blueberry. So using that method, right, Blueberry would be allocated to 50. If we did give Mango 50 depreciation in year 3, and then the business liquidates for the book value, which would be what? 850. If we did 850, we got 850 cash, book value. We had to pay the bank $900. M would have to go out of pocket 50, but M has already gone beyond that because M's capital. So anything beyond that would then go to G. So that's why the $50 would all be allocated in year 3 to Blueberry, because all of that would have to be made up by Blueberry. The last part of the question, then we're done. Would the year 2 allocations have economic effect or alternate economic effect if, as of the end of year 2 operations, the partnership plans in year 3 to borrow $60 on a recourse basis and distribute the proceeds of the loan equally to Blueberry and Mango, and the partnership reasonably expects to earn $60 of net income? And then what if in year 3 the partnership borrows $60 and distributes $30 to each as planned, but unexpectedly earns only $40 of net income? So basically what this does with respect to our issues of selling, what it does, if you're looking at these years, right, and we get to the end of year 2, we've got 50 and negative 50. As of the end of year 2, the partnership plans in year 3 to borrow $60 on a recourse basis and distribute the cash proceeds of the loan equally. So it's going to do $30 and $30. So that would come out, right, 30 and 30. And the partnership reasonably expects to earn $60 of net income in year 3. Well, net income will be allocated, what, 50-50, right? Well, it would keep the allocation the same, would it not? Wouldn't it continue to keep that same allocation? Right? It wouldn't change that. So that would be fine. In year 3, if that's what actually did occur, right? It's saying net income even considering the depreciation. Basically, those two offset one another and would still have a negative 50. That's fine. It still follows that M can go negative 50 because we're allocating $30 of distribution. Distribution reduces capital accounts, reduces basis. And we're also allocating $30 of net income to each, which increases basis and increases capital accounts. So we're good there. That does not violate. But then it's saying, okay, well, what if in year 3 the partnership borrows $60, but then it unexpectedly only earns $40. Well, if we do that, what happens? Now guess what happens? We've only got $20 of income. So that now brings negative 60 to M, and that brings 40 to Blueberry. You can't have negative 60. Remember, we're told there's a QIO. The QIO provision, it basically allows us to redistribute the net income. That's what it's going to do here. Okay? So what it's going to do in this problem, we had 2020, right? This is our net income. So the QIO, what it's going to do is rather than 2020, it's going to say we're going to do 30 to M and 10 to B, which obviously is good for B because that's less income that B has to record. That's a positive thing for B, right? From a tax standpoint. So that changes now our ending balances to 30 here. And this is still negative 50. And that's fine. That's fine. So you can do that. So the purpose of that question is to show you how a QIO operates, right? When we reasonably anticipated a distribution of 30 to each and then $30 of income, the QIO wasn't triggered because it was fine. It still kept us within the 50. If something happens unexpectedly, we can then apply the QIO to trigger it to make sure, hey, it's a safety mechanism to basically say, okay, we know the agreement says you can only go negative 50 M, so that's what we're going to do. We're only going to make sure you only go 50. So we can redistribute that $40 of net income, 30 to M, 10 to B, rather than 2020, and that makes sure that Mango is good.